This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 17th, some highlights from today's show. Germany election is now in focus, the yen carry trade is on, and the SP 500 has got some key gamma levels. Good day traders, and welcome to another week of action-packed trading. Let's kick off and talk a little bit about what to expect in the week ahead. We do have typically the third trading week of each month. It's typically a data light week if we look at it in terms of what we get. There's not a great deal out this week. I think the two key things that really do stand out, of course, is we've got the market PMIs on Friday from the US, which I think will be very closely watched given we did, of course, get a very weak services print last month. So I think that will draw some attention. We will, of course, discuss that in the market rundown later on this week. Aside from that, of course, it's very much the focus for this week will be about OPEX. Every third week of the month we get the futures expiry taking place, and there's a number of things to watch out for this week. I suspect the OPEX is going to matter a little bit more this time around, in a sense of I think it's the one thing that's just going to keep the equities from breaking out, and of course once that OPEX rolls through, I suspect we do get a little bit up into record territory. With that in mind, let's now turn our attention and take a look at our first news topic for today, and that's of course the German election, which is coming into view, and the German voters head to the polls, of course, on Sunday. Now, most of you perhaps don't actually trade European products or German bonds for that matter, but this is something that will be very impactful on both German bonds as well as the German DAX. But the context here matters. Okay, so as we head into this election result, it's not necessarily who comes into power that matters, but it's ultimately what they say once they are in power that is going to matter. Now, the expectation, of course, is that we are going to see the AfD do very, very well. They are going to outperform and most likely come second in the election. This isn't necessarily market moving because we do know, of course, that they are not going to be the ones making the decision, and they are going to need to form part of some form of a coalition government. But I think the key for Germany in particular is this is now going to be the third year running where we are in a recession in Germany. So voters are disgruntled. And I think the one thing to pay attention to is how well the AfD does. Okay, if they massively outperform the polls, is that going to matter for markets? No, perhaps not. You may have a little bit of a scare moment where the euro perhaps gaps down on Sunday, perhaps the DAX also gaps down, but it's not necessarily a thing to worry about unless, of course, for some shock reason they were to be in power. Now, what is important and what we do want to focus very closely on is ultimately what the leader of the CDU tells us, Merz tells us, once he does get elected. So he's expected to win the election. He's expected to be the next premier. And ultimately, what everyone wants to understand is what are the CDU going to do ultimately with regards to the debt brake. Okay, now, written into the German constitution, a government cannot spend more than 0.35% of GDP. Think of this if you compare it to the US, for example. Currently this year, they're expected to spend 6.5% of GDP. So you can see why the US is growing well above the long-term average, around that 2.5%. It's because they're spending 6.5% of GDP in the form of debt. Germany, of course, can only spend 0.35%, so very, very much constrained in the government being able to do any kind of fiscal splash or fiscal spending. Now, it's this debt restraint that was put in place post the global financial crisis that is believed to be the reason why Germany is now in this current situation. It is just effectively years of underinvestment into the German economy. We, of course, then did have the Ukraine war, or the Ukraine-Russia war, which ultimately kind of laid bare the problems in Germany, which was an over-dependence on cheap natural resources coming from Russia in combination with a lack of infrastructure spending. Okay, so This is what the voters are being faced with. Now, what we want to pay attention to post this election is commentary or sources around what MERS is going to do in terms of reform of that debt brake. Any hint, any talk that, look, they're going to relax it to 1% or even higher will send German bonds into a tailspin. Why? Well, because, look, if they're going to spend more, ultimately, they're going to need to issue more. And if they're going to issue more debt, of course, German bonds are not quite reflecting that sort of a situation. Now, what we can see is, again, I wouldn't say this is new news. Okay, if we look at the German curve, what you see in front of you in the purple is German 2-year yields, with orange being the German 10-year yields. We can see that steepener had already begun late last year, early this year. So the German curve has been steepening quite a bit over the course of the last 2 months. At the same time, DAX is breaking out to record highs. So we can see this idea of a debt reform already being priced into the market. The market likes this idea. Why? Well, look, if the government's going to spend more money and they're going to invest more, and we're going to get a conclusion to this war in Ukraine, Russia, the result is we are going to see a much better economic environment than everyone fears. Okay, keep in mind, consensus is for Germany to contract again this year, another third year of recession. So if we start to get not just an ECB cutting rates, but we now get a fiscal government coming in and spending, we do get all the sort of the environment and the context in which we can see the German economy flourish and do very, very well, and even perhaps outperform expectations. Okay, that's why the DAX is at record highs. That's why we're seeing the German curve steepen. Okay. Now, with that in mind, I think, look, for all of this to take place, if we did get some sort of a reform, I think that 260 in the 10 year is going to play an important role. Will this happen this week? No. Will it happen next week? Probably not. We'll find out more about this reform once the CDU is in power and once MERS has settled in and starts to give an idea of his agenda. Okay, now moving on to our next topic. It's all about Japan, and it matters because Japan is no small economy. We know last year in August, we of course did have a little bit of a shakeout in terms of this idea of a carry trade. We'll talk about that in a moment when we get to the chart. But the key takeaways is another hot GDP print from Japan. We had a very, very decent uptick against expectations of inflation last week. So we're seeing both inflation and GDP rise in Japan. And what this is leading to is market participants now thinking that we're actually going to get a half 1 rate hike rather than a half 2 rate hike. In other words, the consensus was they were only going to hike rates late in the year. Now we're starting to see participants call about a rate hike as soon as the July month. Now, of course, if these inflation prints do come out or continue coming out hot, we could see that, of course, pulled in even sooner, perhaps as soon as the March meeting on March the 19th. Now, what matters is in terms of what the markets do, how they respond to it. This is the weekly yen chart. And what we can see is that if we go back to last year, there were two real key events to sort of learn from or be aware of from last year. Below the 65 area, we of course had the BOJ intervening in the currency. Okay, they were effectively buying up their own currency. Why? Because they wanted to stem the weakness and obviously ensure that they're not going to start importing inflation via a weaker currency. Okay, so twice last year we did have actual intervention where the central bank bought up its own currency. Eventually they gave up with this policy and they decided, look, the only other way we can defend the currency is to hike interest rates. What that led to, if we look at the chart, was what we call now the carry trade unwind. So we can see the Japanese yen very aggressively appreciated over a course of 3 weeks. That created a correction, of course, in global equity markets. And eventually, of course, we saw the currency settle down and currencies almost weaken back to where they were earlier in the year. So the point was we had really two real big moves in the yen last year. First, it was the devaluation of the yen. Then it was the significant appreciation of the yen. And in both instances, we did get very good tradable opportunities as day traders. Now, what you want to pay attention to on the chart is we're now back above that 65 level. You can see it's acted as 1, 2, support, 3, a bit of an unwind, 4, a retest, a stop run to the upside. It's come back, it's now pivoted off of it, and now we're sitting back on it again. So we can see the market does pay attention to this. It is an important reference point for the market. I suspect this week we'll settle above it. Okay, I think yen is very much a buy-only market now that the central bank's going to be forced into hiking a little bit sooner than expected. So I do think 67's trade this week, and then I think it's a case of perhaps one last test of the 65, 66 level before we then begin to push our way back up towards that resistance. So it's a very clean technical chart right now with support at 65, resistance at 71, and the path of least resistance is very much towards those 71s. Now, key takeaway, in terms of the carry trade last year, the problem was not that the yen appreciated, the problem was that it appreciated at a very rapid clip. Okay, so a carry trade only comes unstuck when, of course, the thing that you're linked to in terms of the carry has a rapid rate of change. Okay, and that's what caused the panic last year. It was a significant rate of change in the yen. No one was hedged against that rate of change, and so unfortunately they had to become hedged very quickly or dump some of the underlying risk. And that's what happened last year. So pay attention. If we were to, for whatever reason, get above 67, 68, 69 this week, don't be surprised to see that carry trade causing some ripples in the markets. Okay. That being said, we can see that 200-day moving average is substantially higher. We can see that the Japanese yen is very much undervalued relative to that 200-day moving average. So like I said, I think the path of least resistance is very much a move up to 71, and that is a market that is now in play. Let's finish off and talk a little bit about the SP 500. It's a big week in terms of RPEX. We do have some key gamma levels to pay attention to. These levels typically matter when there are very, very big strikes at hand. We've got a very big call strike at 61.50. Now, I'm not an options expert. Don't ask me about options. Don't take what I say as he's an options expert. I'm not. I'm just portraying the messaging and how I understand it. But in essence, 61.50 is a very big call gamma level, very big strike level where effectively they are going to defend this as resistance. So keep a very close eye on that 61.50. It looks as though we are going to run up against that perhaps a number of times this week. Now, why does that matter? Well, for me, looking for a breakout to record highs, I'm not exactly going to be lifting the high tick if there is this very, very big call strike at 61.50. What it does mean is I've got to play this at a slightly different approach. I need to be looking for those dip buys rather than looking to buy through highs. Okay, I mentioned that last week. It is very much a market. I think you have to look to buy the dips rather than be too aggressive at the highs. Of course, once that options expiry follows through next week, that's a different story, at which point we can then resume this idea of breaking out towards record level territory. That in mind, record highs are only about 0.5% away, so it's not exactly a big major call calling for new record highs. But like I said, 61.50 is going to be a big hurdle this week in terms of resistance. On the downside, I think 6100 comes into play. Now, if you were watching that level last week, I think there's quite a lot of gamma exposure there as well. So it is a level that the market probably needs to defend. It will perhaps offer some decent support, but it needs to defend it, because if we get below it, I suspect we may drop in down back towards that 60.50 area. So keep a close eye on 6100. I think that is the area to be buying this week in terms of dips. And like I said, I suspect we are going to sit between 6100 and 6150 for the course of the week as we move into that OPEX. And then once the OPEX clears, I suspect we then get the resumption to the upside. Okay. With that in mind, of course, we can see that VIX is now steadily moving back down towards the yearly lows around that 15 mark. I suspect we do test those 15s and perhaps even go and test a little bit lower around 14.5s. What does this mean? Well, it means should we be trading around that 61.50 on Friday, and should that OPEX clear, and should that VIX be trading sub 15, it really does open the door for those momentum players to take this market up to record highs and beyond. All right, that's in a wrap for today. If there are any other questions, you know what to do. Do post them in the Discord channel. Like I said, it's a light economic calendar. We do have a US bank holiday today, so don't expect anything crazy. That in mind, of course, we will resume normal trading tomorrow when that liquidity comes back to the market. But if you are trading today, as always, manage that risk, go make some money.